In 1980, a single income could buy a home, support a family, and cover retirement. One job often equaled one household. Owning a home wasn't a dream, it was an expectation. Healthcare was affordable. College cost a few $1,000s a year. Most workers had pensions that guaranteed income for life. That wasn't fantasy, that was normal. Today, two professional incomes often feel tight, and not because people suddenly became irresponsible, it's because the rules of the game changed. Over the last 4 decades, the foundation beneath the middle class quietly shifted. Not in one dramatic event, not in one policy decision, but slowly. The middle class isn't collapsing in a crash, it's being compressed bit by bit, squeezed by rising asset prices, by policy incentives that privilege capital over labor, and by financial engineering that multiplies gains for asset owners. This video isn't about motivation, it's about strategy and positioning, because escaping the middle class no longer means grinding harder, it means playing a different game. Part 1. What actually changed? After World War II, the American middle class expanded faster than ever before. Productivity rose, wages matched it. Manufacturing jobs were plentiful. Home prices tracked income growth. College tuition was low enough that a part-time job could cover it, and pensions offered real retirement security. If you showed up and worked hard, the system rewarded you. But beginning in the late 1970s and accelerating through the 1980s, something shifted. The correlation between effort and reward began to break. Productivity kept rising, wages flattened. At the same time, housing began outpacing income growth. Healthcare costs rose multiple times faster than inflation. College tuition surged far beyond wage growth. Pensions were replaced with 401ks, and asset markets accelerated due to globalization, financialization, and falling interest rates. The system didn't collapse, it evolved into two parallel tracks, the wage economy and the asset economy. If you depend primarily on wages, you operate in the linear lane, and if you own appreciating assets, you operate in the exponential lane. The squeeze isn't just about stagnant income, it's about being locked out of ownership during an era of asset inflation. Part 2. Why it feels harder than it should. On paper, today's middle-class household looks stable. 2 incomes, good jobs, solid degrees, but underneath that stability there are large mortgages at elevated valuations, student loans, auto financing, rising insurance premiums, market-based retirement exposure, and healthcare uncertainty. Meanwhile, the ownership class benefited from compounding asset growth. Real estate in major metros tripled or quadrupled. The S&P 500 compounded wealth at record levels. Private equity and venture capital minted fortunes. Those who owned assets early saw passive acceleration, while those dependent on salary had to sprint just to stay in place. It creates a psychological dissonance. You're working harder, earning more nominally, yet feeling less secure. That's not a mindset issue, it's structural asymmetry. Labor scales with time, while ownership scales with capital, and capital compounds. Most people respond to the squeeze by pursuing higher income, which makes sense. But here's the paradox. Higher income often triggers higher fixed obligations, bigger home, private schooling, and lifestyle upgrades. So, income rises and commitments rise faster. You don't escape, you expand the cage. The real trap isn't insufficient earnings, it's lifestyle lock-in. When your monthly burn rate matches your income ceiling, your optionality disappears. And optionality, not income, is the real measure of financial strength. Part 3. How to escape the middle-class squeeze. Escaping doesn't mean becoming ultra-wealthy, it means shifting categories from wage-dependent to ownership-oriented. Here's what that requires. 1. Convert labor into assets. Your job is not the destination, it's the capital engine. Income is raw material, and every dollar earned has a decision attached to it. Consume it or convert it into a productive asset. Productive assets might include broad equity exposure, ownership in small businesses, equity compensation, intellectual property, cash-flowing ventures, and scarce, high-value skills. The objective is simple. Use linear income to acquire exponential assets, and over time, the slope of your financial trajectory changes. At first, insignificantly, then meaningfully. 2. Control fixed costs relentlessly. High fixed costs eliminate flexibility. Housing and essential services is usually the largest cost. Transportation is second. Every dollar permanently locked into lifestyle reduces future investment capacity. Wealth compounds best when your baseline cost structure is stable. Escaping the squeeze is often less about earning dramatically more and more about preventing your cost base from rising alongside income. 3. Prioritize ownership over visibility. Middle-class decisions are often driven by optics. Bigger house and newer car are prestige signals, but status depreciates. Ownership compounds while status demands continuous spending. Ownership generates optionality. The most financially resilient households often look average from the outside because real wealth is quiet. 4. Think in optionality, not salary. The goal isn't maximizing paycheck size, it's maximizing leverage and control. A bigger paycheck can reduce stress, but optionality eliminates it. Optionality is economic breathing room, and breathing room changes how you negotiate with the world. Optionality means you can change jobs without panic. You can invest through downturns. You can take calculated risks, and you're not forced into decisions by cash flow pressure. 5. Play the 15-year game. Escaping the squeeze is not a dramatic leap, it is gradual. Compounding is slow, until it isn't. Over 10 to 20 years, small allocation differences dominate income differences. Two households earning the same salary can diverge massively based on ownership decisions. Eventually, a threshold is crossed where asset growth outpaces effort. That's when the squeeze loosens. Not suddenly, but structurally. The middle class is not failing. It's operating inside a system that quietly shifted its rewards. For most of the 20th century, effort was enough. Today, ownership determines trajectory. If you sell time, you move linearly. If you own assets, you move exponentially. That gap compounds. The squeeze is not about motivation. It's about position, and position can change. Not through hustle, but through allocation. Not through status, but through ownership. The system rewards leverage, so use it, because in the long run, capital outpaces labor, and those who understand that early stop stressing and start compounding. In the next video, I break down a counterintuitive idea, why traditional saving in 2026 may be a losing strategy. Not because saving is bad, but because what you save in and what you allocate it to determines whether you escape or fall further behind. Subscribe so you don't miss it.